Which RSI would you prefer, blue or green? So the green, that is smooth, more polished, a bit more stable, or blue, that is noisy, choppy, and volatile? Again, blue or green? Well, the answer is it depends, and this is what we will review in the rest of the video. We will also discuss how to use the filtered RSI within a algorithmic trading setting to identify long-term market cycles. And we'll give an example of long-only positions. And if we apply this algorithmic trading to a few examples, a few assets, so for instance, to the Nasdaq 100 over a more than 20 years time period, we were able to achieve a win ratio of 80% in this case. Also 80% when we have applied it to the SP 500 ETF over a long period of time, starting from 1998 until May 2025. For the German DAX index, a win ratio of 70%, and for the Dutch IX index, a win ratio of 73%. Now let's go back to our dashboard. So what do we see? We are on the RSI, so relative strength index page, with a Butterworth filter. And what we see in the bottom graph, we see the RSI. So let's remove first the green one. We have a light blue RSI that corresponds to our original asset, unfiltered asset, also here shown on the top graph in light blue. And here we have selected the Nasdaq 100 between January 2020 and May 2025. And so this is the classical RSI. And you could argue that when we look at the Nasdaq here, we could identify potentially 5 main regimes. We can identify 2 short-term market cycles. So the first one here, the first and second quarter of 2020, this was the COVID pandemic. The second one could argue that the tariff period during the first and second quarter of 2025, also here showing a similar V-shaped recovery as the pandemic, is the second short-term market cycle. Next to that, we could potentially also identify 3 long-term market cycles. One here, where you see here a bull period until 2022. So from the recovery of the COVID pandemic until the late 2021, beginning 2022. Then a bear market up until early 2023. And then again, a bull market, long bull market here, as you see, up until the first period of the first quarter of 2025. So these are the 5 main market regimes that we could see in the Nasdaq 100 for the last 5.5 years. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. Now, we would like to make the case that the standard classical RSI is better suited to identify these short-term market patterns, as we have shown here in blue, but that if we want to identify these more long-term movements, and if you are more interested in long-term investments, then we need a different tool or a different signal. And this is why we believe that a filtered version of the price, using, for instance, Butterworth Filter, and this is the example that we show here with this green now signal, green line, which uses a Butterworth filter with a 100-day, in this case, a cutoff period that you can adapt or select here yourself. We want to make the case that actually using these smooth versions of the asset price will help us identify these longer term patterns. And so if we apply now the RSI to this green smooth line, then we should be able to actually identify these long-term patterns. And this is what we will see. So coming back to the bottom graph, the RSI graph, this light blue classical choppy noisy signal is actually the RSI, as we mentioned before, of the original unfiltered asset price. But when we take the filtered one, so this is the green line is the filtered asset price. Now, if we apply the RSI to this green one, then we get this bottom green RSI. And you see this one is way smoother, is way more stable, and this is the one that will allow us to identify these long-term patterns. And obviously you can adjust the cutoff period. You can even go here, let's make, for instance, let's go to 150, just to give you as an example. And you see it becomes even way more stable. And now the trick is to try to find entry and exit positions for your trading. And this is what we will discuss next. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Also, as a quick reminder, we have discussed the application of a Butterworth filter in a previous video where we went over the frequency analysis page and the Butterworth filter page, and we reviewed and we explained a little bit about the definitions and the working principles of such a causal filter that is based on frequency domain filtering. So if you want to have a quick refresh, just go over the video that explains these concepts as well. So now our objective is to identify and trade long-term momentum patterns that are hidden beneath the noise. And so what we will do, first in the top graph, we will only keep what is of interest to us. So in this case, we want to keep the original signal, we remove the filtered one. In the bottom graph, we will do the reverse. We will only keep the filtered RSI. So we'll keep the green one. And we will, in this case, we will take as an example to try to identify actually bull market conditions. So profit from price going up. Now, the basic algorithmic setting is as follows. When the RSI is low and has reached, is bottoming, and then it starts to increase, then we identify here a long entry point. This would qualify as a long entry point. This as well here, it starts to increase. And we will, you could argue that, this is also another one, or this could be another one. But we will also say, this could be also another one, we will say that we will only keep the ones that where the RSI is really below a certain threshold. So that's an additional condition we will add. And for exit points, we will say once the RSI has reached a certain level, flattening up and is very high, and once at the instant it starts to decrease, that's an exit point. So this would be an exit point, this would be an exit point, this would be an exit point, these would be exit points. But here again also we will apply a minimum threshold. So this means the entry point will only qualify if the RSI is below a certain threshold, below, for instance, this line, and the exit points will only qualify if the RSI is above a certain threshold. For instance, this other white line. And you can already see a little bit, if you were to consider this as an entry point, where here is the Nasdaq, and this would be an exit point. So somewhere here would be the Nasdaq. So that's already we're really identifying a nice bull movement here. Similar with these two, entry point, exit there as well. So you see some patterns coming already recurring. And obviously, if you take this one, for instance, here and entry here, entry there, this wouldn't look that much of a winning trade, but maybe slightly well. But we will now start to look at ways to improve the algorithm. But this is the basic setting. Now, once we have identified a promising algorithm, then what we do, in general, we start adding constraints to try to refine its performance. So in this case, you could consider, for instance, adding the SMA and comparing the original signal to an SMA. In this case, we've taken SMA 100, and then only authorize an entry trade or an exit trade depending on how the price is compared to the SMA. So, for instance, if the price is above the SMA, then allow the trade to happen, which would be this case. That would be the case. And if the price is below the SMA, then for close the position. And so you by filtering, adding these additional constraints, then we can also remove some losing trades. So let's recap the three main steps for the design of this simple RSI algorithmic trading framework. So the first step is to apply a pre-processing where we filter the original asset price using a frequency domain Butterworth filter. And in this case, we have used 100 days cutoff period. And we have applied the same filter both for the long entry and the long exit signals. So it's one an identical basically filter. And this is what you see here. The original signal is in light blue. The green smooth one is the filtered version. And this is in the control panel on the dashboard where you can select the filter cutoff period. So this is the first step. The second step is actually the basic setting of the algorithm. In this case, so how to identify the long entry and long exit positions. So for that, we will use the RSI of the filtered signal. And for the long entry, in this case, we said we want the RSI to be below 10. And as soon as the new RSI is above the previous RSI of the previous day, then we have a long entry position. So these are, for instance, you see here, the RSI has converged towards its asymptote. It's stabilized towards a low value. It's below 10. As soon as it starts to increase, then we can identify a long entry position. Similarly, for long exits, if the RSI is above a certain threshold, here we have set it to 90, and as soon as the RSI starts to decrease, then it's a long exit position. So here again, the RSI has reached its asymptote, its max level, and then it starts to decrease. That's an exit position. Similarly here and there. So this is the second step. The third step is to add some constraints. And we'll say, well, the long entry will only be valid if the price is above SMA. In this case, we have chosen also 100 days. And you see the SMA here in yellow. So if the price is above the SMA, the long entry is valid. Similarly, if the price is below the 100 days SMA, then the long exit is valid. Obviously, you could also try different periods. This we have not really done any really fine tuning or refining in optimization. This is just as an example for you. So when we combine all three steps, then we have the total algorithm here shown here. So the pre-processing step, the basic setting, and the constraints. And in a nutshell, you could argue that all algorithmic trading follow this type of framework. There is always some form of pre-processing, some form of filtering. There is the main rule of the algorithm, and then we always try to add some constraints to increase the performance and the robustness of the algorithm. Now let's have a look at the performance of such a RSI algorithmic trading framework. So where we have used the filtered RSI signal, and we have applied it here to the Nasdaq 100 for the time period between January 2004 and May 2025. This has delivered 15 trades, 12 of which are winning trades, so a win ratio of 80%. And the graph shows some interesting results here. So on the x-axis, we have time. On the left y-axis, we have the Nasdaq 100 index points. So this is using daily closing prices. So in blue, that's the index. And the right y-axis shows the percentage gain or loss for each trade. So percentage of the entry position. And the bars, they show the moment we close the trade. So how much did we win or lose on the entry? So the red ones are the losing trades. So we have here approximately minus 15% loss during 2016, one of the three losing ones. And all the other ones are the winning trades. So we see like quite a few high winning trades. At least like 5 of them that are hovering around 20% or higher, up to 45%. We also see no losing trades during the COVID pandemic, no losing trades during the tariff period. The other main losing trade was during the 2008 financial crisis. So what else can we say about these trades? So here, obviously, you only see the moment the trade was closed. You do not see the entry time of that trade, but based on the data that I've looked, these trades, they have quite long holding positions. So on average, between 1, 2, up to 3 years, where a trade is being held. So really, if this is not any high frequency trading at all. So this also the advantage is that there is very low transaction cost or slippage or spread cost due to spreads. So this is really for long-term investors. It's really interesting. What I also forgot to mention is that how do we compute these percentage gain and loss? Basically, when we get the trade entry signal, we just buy the index ETF without leverage. And when we get the exit trading signal, we sell the index. So there is no leverage, there is no stop loss, there is no transaction financing, no trade, no fees included, or bid-ask spreads, or any other transaction costs. So it's just a plain buy and hold, basically, but at specific moments. So, and this is what you see. So every time we buy the index and we close it, and these are the moments we closed it with a win, and these are in red the moments where we close the trade with a loss. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now suppose we modify the algorithm slightly. We just replace the 100 days cutoff period that we used during the pre-processing by 200 days, and we do the same here for the SMA. We replace the 100 days by 200 days. That's the only change we will make. And now we will apply this exact algorithm again to 3 other assets. The first one is the S&P 500 ETF, or known as the SPY. The time period is going to be slightly longer, between January 1998 and May 2025. In this case, we have 10 trades, and 8 of them are winning trades. So again, a win ratio of 80%. That's really a coincidence with the previous performance win ratio of the Nasdaq. And the red one shows the losing trade. So we have almost 10% loss trade during the bear market of the dot-com bubble crisis during 2000 is one here. The other losing trade is very, very small, we can barely see it. And it's during the COVID pandemic. Other than that, we see an impressive series of winning trades of really high percentage gain. So 5 of them are above 20%, going up to the high 30%. So again, these show the moments of the trade exits. These trades are also have also very long holding positions, so on average 1 to 2 years. And it's again, there is no leverage, so there is no stop loss. We just buy the index at certain moments and then we exit. And when we exit, we look, did we make a win or a loss? And this is what you see in the moment of exit of these trades on the graph. So this is for the S&P 500 ETF. Now we apply again the same algorithm without any changes to the DAX index, just to test a little bit its robustness. In this case, we have again 10 trades, 7 winning, so a win ratio of 70%. We see here a substantial loss again during the bear market of the dot-com bubble, and another one during the COVID pandemic. So these are really the two big losses that really jump out of the graph. And another example is the IX Dutch index, also for the same time period. And here we have 11 trades and a win ratio of 73%. We see again here the highest loss, substantial loss during the bear market of the dot-com period. But other than that, like a small loss during the COVID period. But also other than that, like really quite a few high winning trades. So 6 of them above 20%, and 2 of them even above 30%. So yeah, interesting, promising results for a very simple algorithm without much of a tuning or really adjusting the parameters. Now in the next video, we will go over the RSI optimization. And in this case, we'll have a bit more degrees of freedom. On one hand, we will be able to optimize the RSI period and not change it from the standard 14, which is it's classically set towards. And we will also be able to optimize the SMA period and choose other values than the standard 20, 50, 100, or 200. So see you in the next video. Thank you for watching, and until next time.